Hi everybody. So this is the first video, and I'm trying to. Okay, so hi everybody. This is the first video I'm making, and we have a YouTube channel on which we have put quite a few videos. But I'm new to TradingView, and I wrote some scripts. One of them I've already shared. So the thing is, I'm majorly into long-term investments and on more on the fundamental side. So this first video is just an attempt. For me also, I'm trying to learn, but the fundamentals is what we'll be talking about. So this is a slightly complex chart, if you will. Uh, right at the top, this line is the okay. My algos got triggered. Uh, so this is the yellow line is the 10-year GSEC yield of India, which is 7.3%. This is a daily chart. And this black line is India's 1-year yield, 7.2%. So as you can very clearly see that both the yields are very close to each other. So we have a flattish kind of an yield curve, uh, which is very much different from this blue and red line which you can see here. So the blue line is US 1 year, which is 5.5%, and red line is US 10 year, which is 4.5%. So US 1 year yield is more than US 10 year yield, and that's an inverted yield curve. India 10-year yield is technically slightly above 1 year yield. So it's not an inverted, but this is a flat yield curve. So, you have two very different types of yield curves in India and US. And now what is happening? Everybody is talking about rising US yields. So you can see this US yield, the 10-year GSEC is rising for the past so many months. Now, although the interesting part is this: if the yield of the US is rising, then technically the Indian market yield should also rise. But the good part here, which shows the strength of the Indian economy, is our yields have been largely flat in the 7.2, 7.3 range, a 10-year GSEC, although the US yield has been increasing. So, the difference between US and Indian yields is actually compressing. Now, what does this mean? It means if US is offering 4% and India is offering 7%, then there's a 3% difference between the two yields. Now, if that 3% different comes down to let's say, or let's say here it was 3% and 7%. So it was 4%, and now that difference has come down to 3%. So the yield difference between US and India has come down by a whole 1%. And that should translate into a big rupee fall, because that should, because money should come out of India, because it's no more attractive, because US itself is becoming attractive. So we are seeing that happening in India. A lot of dollar selling is happening in the equity markets by the FIIs, and that money is going back to the US. Fine. But even then, now look at this candlestick chart, which is the USD INR. So you can see over the last, while the US yield has appreciated and Indian yield has stayed flat, even the rupee has largely stayed in the 83 rupee USD INR. So here we have a condition where the yield differential is coming down. uh, the FII selling is happening in the markets, equity markets. So because of that, equity market is coming down, but that is countered by a huge DII inflow, mutual funds, 12,000 crores, 13,000 crores, 16,000 crores. So we are having a very unique situation where FII selling is being countered in the equity market, and the money which they are trying to take out, they are not I mean, the rupee is not getting pounded, because RBI is actively intervening and ensuring that the rupee stays in the 83 uh, range or sort in whatever they are thinking. They usually don't divulge so many detail. They only say we try to maintain the volatility. We never fix the level. So, but it has been observed that in spite of all the global turmoil, we have two wars going on, and in spite of that, neither is our equity market falling thanks to local equity, DII, and retail investor support, and neither is the rupee crashing, nor is the yield really skyrocketing. So here, India is positioned in a very uniquely strong manner, and as the global headwinds turn into tailwinds, and as global economy picks up, today India is the driver of global economy. But as headwinds turn into tailwind, now also what is happening is, for a variety of reasons, the dollar, the US, I mean, the oil price is coming down, and oil price below 100, oil price at 80, 85, 87 is also a fundamentally big boost for India. So look at it any which ways, the fundamentals, not just local liquidity of EPFO money or mutual fund money, SIP money, or insurance money coming in. No, not just that. It's the overall fundamentals. Looking at the yields and the yield curves, that India looks poised. India looks poised with so much of money expected to come in the bond markets, because Indian bonds have been included in the JP Morgan index, and sooner or later they will be included in other bond market indices. So if foreign money again starts coming in, it's quite likely that both these yields will again start dipping down, and because of that the rupee may again try to push the 82, 81 again. RBI may not want to do that. So if we are able to kind of crystal gaze 1 year into the future, then the scenario looks that much better. And therefore, the algo which I have shared, it's for long-term investors. What it essentially does is it buys on every dip, and it's a pyramiding indicator. So as the market goes down, if you put it on 15-minute, 30-minute, whichever candle, 1 day, if the low of this candle is lower than the low of previous candle, it automatically gets the buy gets triggered, and I've set the target at 100% above the average buying price. So the pyramiding thing happens in the indicator, and you can sell when the price suddenly jumps up. So that much for the first video. Please give your feedbacks. We have a YouTube channel by the same name, Moneybee, and in the description I have given that also. There's a link to the YouTube channel also. So please visit that. We have videos on bond markets in English, in Hindi, some in Marathi. So please do let me know uh, how you find the content and the delivery of this particular video. I will try to make the videos even smaller. 8.5 minutes is like an era in today's time and world. So thank you so much. Bye.